Welcome to another episode. My name's Jose Najarro, and today we're going to take a look at Cisco earnings for quarter one of fiscal year of 2020. Like always, I have my buddies Bull Solo and Darth Bear ready to keep track to see how the company's doing. So let's get started. Before I begin, all the information collected has come from either Cisco's investors website, seekingalpha.com, or marketwatch.com. So you guys can check out those websites if you guys want to look at more information. Now let's take a look at the stock return. In the past 5 days, Cisco has returned negative 7%. In the past month, negative 5.6%. In the past 3 months, negative 7.8%. Year to date, it's only up 3.16%. And in the past year is down negative 2.3%. So we can see while the market is hitting all-time highs, year to date, Cisco has only provided a 3.16% return. So obviously now is the time for me where I want to take a look at this company and see if this is the perfect time to invest in Cisco. First thing we're going to take a look at is revenue. Revenue for quarter one on non-GAAP earnings per share of 84 cents beats by 3 cents. GAAP earnings per share of 68 cents beats by 1 cent. And revenue of $13.16 billion beats by 7 million. So obviously the first point I'm going to have to give here is to Bull Solo. We have earnings per share beat and we have revenue beat for this quarter. Next, we're going to take a look at comparable sales. We want to see how Cisco is doing with its revenue and where is its revenue coming from. One thing to note is last year this company sold a part of its business called the SPVSS business. And one thing Cisco was kind enough to do was they were able to take a look at the past quarters and removed all the revenue that came from this business so that we would be able to do a direct comparison between the two revenues. So that's the one in the bottom here, which I have highlighted in green, and that's what we're going to take a look. So first, let's understand where Cisco's revenue comes from. So remember, we mentioned that there was about a $13.16 billion of revenue. So 3.3 billion of that comes from services. The other 9.8 billion comes from products. And the products is distributed between 4 products: infrastructure platforms, applications, security, and other products. And we can see the biggest one of them all is infrastructure platforms, which brings in $7.5 billion of that $13.1 billion. So over half of the revenue comes from that type of products. Then we have applications that bring 1.5 billion, security that only brings $800 million, other products which bring in only $26 million. So first, let's just take a look at overall total revenue. And overall total revenue, if we exclude the previous business that they sold, is up 2%. So there is some growth compared to the same time last year. If we take a look, even when they still had that business that they sold, revenue will still be up by 1%. So that's actually pretty good news. It means that that company, that business that they sold off, wasn't as strong of a unit for Cisco. So that might have been the reason that they let that company go. But let's take a look at the products and see how they're doing individually. Infrastructure platforms is down 1%. Applications, it's up 6%. This one I thought was pretty interesting. Security is up 22%. And seeing this right now is still a huge time to look at companies that have some form of online security for cloud applications and for all this software application securities. We can see, right, it's up 22%. So right now is still the time I'm probably going to take a look at some of the companies, some software security companies, and see how they're doing. Other products is down 20%, but other products is only $26 million. So down 20% means this company is down, in other products is only down about $3 million, which is pretty much chump change for this company. Total products in general is up 1%, and services is up 4%. And in total, all this adds up to a 2% gain for revenue year to year. One thing this company is trying to do is all of its software revenue is trying to make it subscription based, which we know, right? Every company and every company is trying to do some form of subscription method. We can see Microsoft did it with Office 365, right? Where now Microsoft Word and all Microsoft Offices are in a yearly annual subscription-based methods. They even have monthly subscriptions. And this is what Cisco is doing. Right now, 71% of their total software revenue is subscription based, and that's up 12% year to year, 12 points year to year, not 12%. And obviously perpetual, which means just one-time payment, is down 12%, but that obviously makes sense. If subscription is up 71% out of that 100%, perpetual has to go down by that same percent. And that's actually a pretty amazing number, that already 71% of the total revenue comes from subscription. So right, one thing we're seeing a total revenue increase by 2%. We see a huge amount of products having increase in gains year to year gain. And the only big one being down is infrastructure platform, which is down to 1%. I'm not counting other products because 20% of 28 million is pretty much nothing. So I'm not counting that. So overall, this company's comparable sales are doing pretty good. And for that reason, I'm going to have to give a point to Bull Solo. Now, I just want to take a look at revenue and how it's collected among the countries. America is the biggest customer for Cisco, where it brings $8 billion of that $13 billion revenue, and it's up 4% year to year. The next is Europe, Middle East, and Africa, which brings in $3.2 billion, and it's up 4%. Asia Pacific, Japan, and China is down 8%, but these are the smallest of them all, and it brings only $1.9 billion. So we can see there is a slowdown happening in that part of the world, Japan, China. But the great thing is this part of the company is not a huge percent of the revenue, right? $2 billion of that 13 billion is less than 20% of the total revenue. Still a huge portion amount, but overall it's not as big as seeing America down 8%. Next, we're going to take a look at future plans. So future plans is one that I just like to see if the company is doing something in the future. Do they have some form of roadmap? Do they know where they're going? And I think this is very important for any company to have. So even if I can't determine if the plan they have is the best plan because I can't see the future. But as long as they have a plan, that's all that matters to me, because it gives them some form of roadmap to follow. And they do have a roadmap, and I'm going to discuss some of the stuff that they're doing. The first thing is they're trying to transition their products to software, and this is continues to progress. And they're saying this transition to software not only aligns to how the customers wants to consume their technologies, but they also believe that it will lessen the impact of macroeconomic shifts in the future. Despite the current uncertainties, they still have a strong pipeline of innovation. And at the annual partner summit that they did last week, which I now think is 2 weeks ago, they announced several exciting additional products. And over the next couple of months, you will see deliver even more innovation. During Q1, they closed 4 acquisitions. This company is buying out a lot of companies, and they're all in the applications area. These moves are inconsistent with the strategy of increasing investments in innovation and research development for growth areas. And this is one thing we see a lot of big companies do, right? We see Google do it, we see Amazon do it, where they know where for them it makes more sense to actually just buy a startup company that has already done a few of the groundworks instead of of Cisco himself putting out its resources to develop something new. And like I said, they purchased 4 companies. They closed 4 acquisitions just on this quarter alone because they're trying to grow their overall innovations. So that's definitely a great thing. Innovating is the best thing that can keep happening. Once a company stays still is the time when the company starts to lose and bleed money. They continue to drive innovations and calibration efforts with artificial intelligence and machine learning. During the quarter, one of the acquisitions they bought was CloudCherry, which is a market-leading customer experience management solution, and they want to use their contact center portfolio with cloud analytics and artificial intelligence to increase productivity and enhance user experiences. They also have investments in app dynamics and has made Cisco the leader in application monitoring and analytics. So we can see, right, this company is doing a lot of things. They are focusing a lot in artificial intelligence. They're focusing a lot in machine learning. They're focusing and buying a lot of companies so they're able to keep up with the trend that the world is going. And they also are still releasing plenty of products, and they have a strong pipeline. So for that reason, I have to give another point to Bull Solo. Now we're going to take a look at shareholder returns. For this quarter, the company returned $2.3 billion to shareholders through the way of share buyback and dividends. In the repurchase program, they repurchased about 16 million shares at an average price of $48.91. Right now, the current stock price is about $46, so you can even buy the shares now cheaper than what they did. This aggregated to about $768 million worth of purchases. They still have $12.7 billion left to buy back shares, and there is no termination date. So maybe with this price decrease going down, they probably even went heavier and bought some more shares. We'll be able to see that in the next quarter earnings. They also do a dividends, and they declared a cash dividend of 35 cents per common share, or about $1.5 billion. And this is pretty impressive. Cisco actually has a 3.1% dividend yield with its current price range. And for a tech company, I think that's actually pretty impressive for the dividend yield that this company has. So obviously another point to Bull Solo here. Bull Solo is definitely killing it. Darth Bear. Has Darth Bear even gotten a point? Nope, no point for Darth Bear so far. All right, next we're going to take a look at this company's debt. First thing to note is current assets has taken a hit of about $6 billion in the past 3 months. So 3 months ago, July 27, 2019, which was the previous quarter, this company had about $11.7 billion of cash. Now this company is sitting at $8.5 billion of cash. So that's alone a little over $3 billion of cash decrease. Then this company, same time 3 months ago, was sitting at $21.6 billion of investments, where now this company is sitting at $19.5 billion of investment, so about $2 billion less. And this company also has about $600 million less of accounts receivable. So overall, this company has taken about $6 billion of current assets loss. 3 months ago, this at total current assets, this company was sitting at $47.7 billion. Now this company is sitting at $41.7 billion. So we can see a $6 billion loss. But that comes with good news. Current liabilities is down $7 billion in the past 3 months. Total current liabilities, July 27, 2019, was sitting at $31.7 billion, where right now it's sitting at $24.5 billion. A huge portion of that comes from short-term debt. Short-term debt 3 months ago was at $10.2 billion, and right now it's at a flat $4 billion. Long-term debt still remains the same, sitting at about $4.5 billion. But hey, we see a decrease of $6 billion in cash, but overall we see a $7 billion decrease in current liabilities. So we can see this company is definitely has enough cash flow and has enough current assets to be able to pay off its current liabilities. And for that reason, I'm going to have to give another point to Bull Solo. Right now, these numbers don't give me anything to be worried about with how the company is going to have to pay off any of its debt. Next, we're going to take a look at Darth Bear here. So this is the biggest thing to talk about. And I believe this is the main reason Cisco is down since earnings. Outlook based on the company. So for Q2, this company gave a guidance that revenue will be down about 3 to 5% compared to a year ago. And obviously, one bad quarter is not enough to really affect the company, but the decrease in revenue is not only for Q2. In the earnings call that I took a look at, they mentioned that the slowness will continue for the next few quarters. And this is slowness that they're seeing in all the markets. They're seeing it in Americas, they're seeing Europe, and they're also seeing it in China. And when they see it in all these markets all at the same time, it just means that a slowness is coming. So this is the main reason that this company is down big. They do mention, though, that the slowdown is not affecting all the products. So right now they're continuously working on how to make their strong products that are still doing good to do even better, and their weak products, the ones that are being affected by the slowdown, how they can make them less heavy in their portfolio. But obviously, seeing that revenue down for Q2 and hearing about the slowdown for the upcoming quarter, I'm gonna have to give a point to Darth Bear. So Darth Bear here comes in and makes sure he gets at least 1 point for this video. Next, we're going to take a look at Outlook based on analysts. So here, first thing we're going to take a look at is earnings per share growth. First thing to notice, though, is this company has a very low forward PE ratio for a tech giant that pays dividend. This company has a forward PE ratio of 13.26 for July 2021. Honestly, for me, for a tech giant like this that pays dividend, that has a huge portfolio of revenue, and it seems to have a pretty healthy balance sheet so far, I would easily pay a 15 PE ratio on this company. So right now, I definitely am thinking about picking up some shares. But let's continue. Earnings per share of 2019 is greater than 2020. So we can see there is a slowdown, right? For 2020, this company is estimated to provide $3.24 of earnings per share. And for 2019, this past quarter, it was a bit higher than that. Earnings per share, though, does seem to continue its growth from 2020 to 2021, right? In 2020, like I mentioned, $3.24. In 2021, it's estimated $3.40, which gives this a forward PE ratio of 13.26. Next, we're going to take a look at revenue growth. Revenue of 2019 was $51.7 billion, and this is not counting that business section that they sold. So $51.7 billion for 2019 is higher than what is expected for July 2020. For July 2020, they are expecting $51 billion. So we see this slowdown happening, but this slowdown doesn't seem to be a huge slowdown, right? From 51.7 to $51 billion. That does not seem like a huge reason for this company to be down so big. For 2021, though, revenue continues to grow, sitting at $52.54 billion of estimated revenue, which is higher than both 2020 and 2019. The next thing to see is this company has a very low forward price to sales ratio, and that to me is pretty impressive that it's as low as 3.64%. So this company's future does seem pretty good, even with the slowness that is coming. So this is, for me, definitely a time to buy. I am gonna take up some few shares, and I am gonna do a future video where I show my account and all the shares that I purchased based on all these videos that I'm doing. So let me know what you guys think of the video. I hope you guys enjoy it. Make sure to subscribe, make sure to give me a thumbs up, and post on the comments on what you think about Cisco. Do you think this drop is just too much noise happening right now, or do you expect the drop to continue? So take care, guys. Have a good night, and see you next time.